You can predict a company's earnings perfectly. You read the report, you nail the direction, the stock gaps up 8% the next morning, and your call option is still down 40%. If that has ever happened to you, you are not cursed and you are not stupid. You just traded against a structure you didn't understand. Before we go further, one thing. This is educational commentary, not personalized financial advice. Nothing here is a recommendation to buy or sell anything. Here's why this matters right now. Every quarter, tens of thousands of retail traders pile into weekly options on names like Nvidia, Tesla, and Apple the day before earnings. It feels like the obvious play. You have a view, earnings is the catalyst, options give you leverage. But the options market has already thought about all of that, and it prices your enthusiasm directly into the contract before you ever click buy. Let's start with the single most important concept, implied volatility and what happens to it after the print. Implied volatility is the market's estimate of how much a stock might move, and it's baked into every option price. Before earnings, uncertainty is high, so implied volatility gets bid up. That inflated volatility makes options expensive. The instant earnings are released, the uncertainty disappears. The event happened. And implied volatility collapses, often by half or more overnight. Traders call this IV crush. Think about what that means for your position. An options price has two parts: intrinsic value, the real in-the-money amount, and extrinsic value, which is mostly a function of implied volatility and time. When IV crush hits, that extrinsic value evaporates. So even if the stock moves in your direction, the volatility component you paid for gets refunded to nobody. You bought insurance the day before the storm was announced, and it expired the moment the storm was named. Now the second concept, and this is the one that separates people who understand the game from people who just have opinions: the expected move. The options market publishes, indirectly, exactly how big a move it's pricing in. You can approximate it by taking the price of the at-the-money straddle, the call plus the put at the current strike for the nearest expiration after earnings, and dividing by the stock price. That number is the move the market considers a coin flip. Let me make this concrete with realistic numbers. Say a stock trades at $200 going into earnings. The weekly straddle costs $16. That implies an expected move of about 8% or $16 in either direction. Now you buy a call, convinced the company will beat. Earnings come out, they do beat. The stock rises 6% to $212. You were right, but you needed more than 8% just to break even on the volatility premium you paid. A 6% move that everyone expected leaves your call underwater. You were correct and still lost. This is the core misunderstanding. On earnings, you are not betting on direction. You are betting on magnitude relative to what's already priced. The market doesn't pay you for being right about the news. It pays you for being right about how far the stock moves beyond the consensus expectation. A good earnings report that's merely as good as expected is, for an option buyer, a losing event. Third point, skew and positioning. The options market doesn't price upside and downside symmetrically. For many stocks, especially after a big run-up, downside puts carry higher implied volatility because that's where the fear is. That means the market is often more braced for a drop than a pop. When retail crowds into cheap-looking out-of-the-money calls, they're frequently buying the exact side that needs a monster move to pay off, while the smart money sells them that lottery ticket and collects the crushed premium. Fourth, and this is subtle, the reaction is a two-variable problem, and retail almost always solves for one. The stock's move depends on the actual result versus the whisper number, which is often higher than the published analyst estimate, and it depends on guidance, which is forward-looking and dominates the reaction more than the quarter itself. You can be right about the past quarter and dead wrong about how management frames the next one. Netflix and Meta have both delivered strong quarters that sold off hard on soft guidance. The number you researched was already old news the moment it printed. So let's tie the mechanism together. You paid an inflated premium because of pre-earnings IV. You needed a move bigger than the expected move just to break even. You may have bought the skewed, lower probability side, and the actual driver, forward guidance, wasn't even in your thesis. 4 separate headwinds, all working against a directional option buyer at once. Being right about the company was necessary. It was never sufficient. Here's what a disciplined trader actually does with this. First, they calculate the expected move before doing anything, and they ask a harder question than which direction. They ask, do I believe the real move will be bigger or smaller than what's priced? If you think it'll be smaller, buying options is structurally wrong no matter how confident you are on direction. That alone eliminates most bad earnings trades. Second, they consider structures that don't die from IV crush. Instead of a naked long call, a defined risk spread sells some of that inflated premium back to the market, financing part of your position so the volatility collapse hurts less. You give up unlimited upside, but you stop paying full retail price for volatility you know is about to evaporate. The point isn't that spreads are magic. The point is matching the structure to the volatility environment instead of fighting it. Third, they size for the possibility that a correct thesis loses. If a single earnings bet can take out more than 1 or 2% of your account, you are not trading, you are gambling with extra steps. The traders who survive treat every earnings play as a probabilistic event with a genuine chance of a total loss, and they never risk an amount that would force them to trade scared next week. And fourth, the most contrarian move of all, sometimes the disciplined play is to not trade the event at all. If the expected move is huge, the premium is rich, and your edge is only a directional hunch, the honest answer is that you have no edge. Sitting out is a position. Professionals pass on far more setups than they take. The market runs earnings every single quarter forever. You do not have to be in this one. So the next time you're staring at a call option the night before a print, run the checklist. What's the expected move? Do I think reality beats it? Is my structure going to survive IV crush? Am I sized to be wrong? If you can't answer those cleanly, the setup isn't an opportunity, it's a tax on your conviction. If this reframed how you think about earnings, subscribe and stick around because we break down the mechanism, not the hype. Trade the math, not the story.